Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Making a return visit with me here today is Marshall Berol, the co-portfolio manager of the Encompass Fund. Marshall, thank you very much for coming back on the show.
My pleasure, Mike. It's always good to be with you.
Well, give us your overview here. We had you on a while back. I know your fund is heavily invested in raw materials. It was at one time one of the top performing funds of world equity funds, correct?
Correct.
Out of a universe of 800 world equity funds, your fund, heavily loaded with natural resource plays, was the number one performing fund.
Right. 2008, as everybody I'm sure remembers, was not a good year for the stock market.
No.
It wasn't a good year for any companies.
Just about anything.
And the Encompass Fund in 2009, though, came back strongly. We were up 137% and followed in 2010 up 60%. And so for the 3 years ended 2011, even though the end of 11 wasn't all that good, we were the number one performing world stock fund according to Morningstar on a trailing 3-year basis. We're still up there in the top 2%. And we do invest in a lot of resource companies. The Encompass Fund was set up to invest anywhere. We invest in any areas that we think are attractive. We've thought resource companies were attractive when we started the fund almost 6 years ago. We still think they're attractive. The precious metals, the industrial metals, some portions of the energy complex.
So how has the fund performed since that high watermark, that peak? It's trailed off a bit, hasn't it?
Well, it trailed off at the end of 2011 when, again, the market, the overall market was flat, but a lot of the resource company stocks went down the latter part of 2011, as did other companies where there was liquidations, tax loss selling. For the first quarter of this year, the fund was up 18%, and we're still nicely ahead for the year to date. And we're very optimistic that the areas that we're invested in, gold and silver, copper, other industrial metals such as antimony, and various parts of energy, oil, coal, uranium, are going to continue to do well over the long term, and we're long-term investors. We're not a trading fund.
Okay, so this period now of consolidation or correction, I mean, we saw precious metals hit highs last year and trail off. We saw copper prices come down. They've rebounded a little bit. We see coal prices coming down very sharply. Steel prices have come down. I guess you would view this as a correction in a longer-term trend?
Yes, or a consolidation. I think if you look at gold and silver, it's more of a consolidation, a correction, if you will. That's terminology. But the fact of the matter is the reasons that gold went up has gone up for the last 11 years is a variety of reasons, and basically none of which are solved. There's still geopolitical problems. There's still debt problems. There's still deficit problems. Europe comes and goes, being in the headlines, and they're making some progress, but the problems aren't solved. We still definitely have debt and deficit problems in the United States.
Well, what kind
Gold
of problems is that? I mean, if you look at the debt, which is now above $15 trillion. And the debt has gone in 1980 from $800 billion to $15 trillion, almost a 20-fold increase in the debt. And interest rates have gone from 20% to zero. And the stock market has gone up. We're in a rebound economically. We see the economy back to growth. Like, I keep hearing this, there's problems. But yet when you look at other barometers of these so-called problems, equity performance, GDP, inflation, interest rates, even the dollar, if you look at the dollar index, which is a measure against a basket of currencies, it's up from where it was in 2008.
They are up because with the problems, there's still some modest growth in the United States. We would like to see better or more, but there's modest growth, and there's still very good growth in other parts of the world. When the headlines are that China's growth is slowing, they're talking about from 8.7% to 8.5%, and that's off of a larger base. So you need to take it in the context.
Yeah, but it went from 12% to 8%. Right? I mean, that's a 40% or 30% reduction in its GDP. That would be like us going from 2%, all right, to like 1.4% or 1% or something like that. That's a significant reduction.
It is a significant reduction, but it's off of a larger base, that reduction, and the growth is still there. China is still using copper. Yes, you can say copper's gone from 390 to 370 or 360, but that's up from 70 cents if you want to go back 20 years. And it has stayed up. Oil is up. The one commodity that is really down and will return, will come back, but who knows when, is natural gas. And so the fund is very invested to a very minor degree in natural gas. But you talk about gold. Gold's a storehouse of value. People have bought gold for 6,000 years, and we know that and we hear that. But only for the last 3 years have the central banks been net buyers of gold. For the previous 20, they were net sellers of gold, the central banks, the IMF. Now they're net buyers. People want to own gold. The consumer, the increasing number of consumers, middle class in China and India, who have a culture of owning gold, wanting to own gold, have more money and are buying gold. And so we think that gold's going to continue to go up. And yes, there are fluctuations, but it's also a supply-demand situation. It is increasingly difficult, whether it's gold or silver or anything, oil, uranium, copper, it's increasingly difficult to find it, to get permitted, to deal with the environmental issues, to deal with the local peoples, and to get into production and to increase production of any of these commodities. And that has led to more difficult supply situations while demand's growing.
Let me talk. I want to switch back to natural gas. You mentioned, I mean, that's very interesting to me, trading below $2. Why wouldn't you be really aggressive here? You're saying we're taking a small position in natural gas, but like when would you really commit to it? When it goes back up to 5?
No, not long before 5. Right at the moment. And it looks like it got below $2, $1.98 or 5 or somewhere in there, and it looks like it's trying to establish a base, and that's going to take a time. It's going to take production coming off. The drilling rigs are down. Drilling rig count is down. Some of the smaller companies are going to start closing in production because they can't afford to keep production, and the banks aren't going to let them afford to keep it.
Yeah, this reminds me exactly
So at some point, you say when, that's the unknown, the big unknown. And you don't wait till it goes up, but you wait till at least it's bottomed. We have, over the last several years, gone back into natural gas, found out we were too early, got back out. But somewhere in here, and what the timing is very difficult, somewhere in here is going to be the bottom, which you will realize when you look back.
It reminds me of 1998, oil prices at $10 a barrel, big articles in The Economist magazine, how oil is going to stay in single digits for years and years to come, right? Or back in the mid-90s when gold was at $250 an ounce, nobody wanted to touch it. And getting back to your example of the central banks, I don't know if you want to use that example because they were big sellers. Now they're big buyers. So I don't know timing-wise, if they're that savvy. But I hear what you're saying. Anyway, I guess you see the outlook as this is a great time right now. We're having this consolidation in raw materials. It's been happening since last year. But people should really get the exposure now, right?
They should get the exposure. If they don't have any, start to get exposure. You don't have to go 100%, be 100% in or 100% out, but put a portion in, 25% or a third, and get a portion. If it goes a little lower, get an additional, put some more money in. If it goes higher, you're in at a lower average price. And these are the times. It's more difficult when a market's down to be invested. That's the time to be invested.
I totally agree.
Not buying at the high, then getting disappointed and selling at the low, which unfortunately
is what a lot of people do.
What a lot of people do, and is not the way to do it.
Right, Marshall Berol. Thank you very much.
Thank you.
That's it for now, folks. This is Mike Norman signing off. We'll see you here next time. Bye-bye.